In this video, traders, we're going to look at which is the more important time frame when you're trading intraday. Is it the 15-minute or the daily from a perspective of looking at the broader trend? Stay tuned. Hey guys, warm welcome to you. Alright, so if we're day trading and we're looking to trade intraday, most of us are looking at 1 minute, 3 minute, 5 minute, something like that. And we're trading based on those little nuances and moves and wicks and pulses and drives and trends, etc., depending on the kind of strategies that we're trading. But we also know that it's imperative to check the higher time frame to see exactly what's going on, so we can align ourselves with that. We can create a bias, we can create a structure, and we can add that to potentially a trade filter. One of the things that we look at is the filter to make sure we go to the next filter, the next filter, the next filter before we even get involved with the trade. So, which is the most important? Is it the daily or is it the 15-minute? So if we can imagine, we've got a chart here. We've got the daily chart. It's been chugging up for multiple years. It's got a beautiful uptrend, not a problem. The 15-minute, however, starting to look like this. We've started to come down a little bit and we're starting to pull back. And so over this multi-day period, we've got this downtrend. It's a bit of a range actually, isn't it? A bit of a range downtrend. You can draw a trend line there, but whatever. The point is we've got two things that are in counter trend to each other. So which is the most important? Well, it's going to depend, number one, on the time frame we're trading. Intraday can be pretty broad, right? If we're scalping, then really the day isn't that important. If we're grabbing a few ticks out of the market, even 10, 15 ticks out of the market, how important is the daily? Probably not that much, unless we're at a really big level. So let's say, this low's been holding for a few times and we're at that and we're trying to scalp short on that. We might want to be a little bit careful and be aware of that. Could we ignore it? Potentially if we're scalping for a little pulse through, but that's a different ball game. What about if we're trading over kind of half a day, a few hours, something like that? Then things start to get a bit different. Is the daily that important? Well, it could be. We're starting to get a little bit more interesting, and so we might want to start to look at the daily and go, okay, what's going on? Well, we're an uptrend, but ultimately if I'd been long and trying to play the long side for the past 3 days, I'd have just literally got my head handed to me, because the 15-minute chart has just been pushing down and down and down. And I know you could have bought long in this example here, but over the time period, it's just been a downtrend. And so you start to then go, right, well, I need to look at the most important time frame for what I'm trading as to what's happening. So in other words, if this 15-minute chart is downtrending, we need to be aware that that is the case, and we need to be aligned with that, unless we're approaching a level on a daily where we believe could be the end of the down move, in which case we need to look at our daily, and even though we've got our 15-minute, we need to put them both in sync. Now, if we're just starting to push down here, and let's say we're thinking on the daily, we've got loads of fresh air to the downside or loads of fresh air to the upside. If we're pushing up on the 15-minute, then the daily becomes irrelevant. The daily becomes completely irrelevant, but it's almost like a pyramid process. So we start out with the daily and go, okay, well, what's the 15-minute looking like on the daily? Right, well, the 15-minute is in kind of fresh air, no man's land. We're pushing lower, we're coming off the highs, we've got plenty of room to go. I don't need to look at the daily anymore. I know that it's all about the 15 and the 5. However, if let's say we're double bottoming, let's say, okay, even better, we're coming back to this level here, all of a sudden, now that becomes important. And so we need to have that marked on our 15-minute chart. Now we've done our due diligence, if you like, at the high level, and we go down a level, chunk, down to the 15-minute. And then we look at the 15-minute, we go, right, we've got a key level in from the daily. No need to look at that again. We know that if we start to push back up, then we're not going to suddenly shoot back up to highs unless it's some kind of catalyst in one day. But we know that potentially we could have a bottoming pattern around this because it's been support before. And so we start to look at it with its own merits based on this extra bit of information, which is this bottoming, which is this potential support area. So we get the information we need that fits in this. If the 15-minute, if we've been chugging up and the 15-minute chugging up, then this is no use whatsoever for us unless the 15-minute starts pulling back. It's only when areas and levels of interest on that higher time frame come into play do we then transition them to our lower time frame on the 15-minute. And then we say, right, well, the trend is down on the 15-minute. However, I'm aware of a potential floor down here which I need to be aware of. So I'm going to be scalping short, I'm going to be playing on the short side, I'm going to be, anytime we're above this, I'm going to be looking for the short side on my intraday charts. I know the 15-minute trend is down. Yes, this is a bit of a range bound thing, so potentially maybe if you were down here you might say, well, I need it to unwind a little bit. But the point is you align yourself with that 15-minute trend because you've got such a short time frame that you're trading off. You're not looking for anything more than a couple of hours. So this becomes irrelevant until that level comes in. It's the same when you kind of step down against your 5, isn't it? You know, guys, if you're trading, you look at your 15-minute, you go, right, we're in a kind of channel here. As an example, we're pushing down. Right, well, I know that even though we're in a downtrend there, on my 5-minute, on 2 days worth of trade, we know that there's a kind of bit of support here, and there's a trend, and there's a bottom of a trend line there. And so maybe if we're extended on the 5 and we've moved quite a lot in the 5-minute and we've stretched, it might be a little place for it to spring back. You know, it might be like, oh, a bit of extension and stretch. Oh yes, it's extended on the 5 and we're hitting that lower trend line and we're hitting this and we're hitting that on the higher time frames. That might be just enough to stop that stretch. It's already running out of puff a little bit for a quick retracement back to the moving average, to the mean, whatever it may be, quick 15, 20, 30, 40, 50 ticks, whatever you're looking for. So which in day trading, which is the most important time frame, the daily or the 15-minute? I've isolated these two because these are the super popular ones. I'd say this, the 15-minute is the most popular one because you're going to get more information from that. However, you don't disregard the daily when there's levels coming into play. When you're in fresh territory, it doesn't matter, it's irrelevant. It's all about that lower time frame. But when there's levels are coming into play, you need to take them, move them to your 15-minute, and then you can forget about it. I think too many people kind of keep stuff up, which is no need to have it. Same as you're running from a weekly kind of to a daily downwards. Once you've got the levels that are important, then you can work off those. So 15-minute is the big one, guys. I think that is the one that's the most important, as long as you are cautious enough to make sure you take your dailies. So in other words, even though this is an uptrend and we're strong, the 15-minute for a day trading perspective trumps it if we're not obviously in support, because this is the one that's acting and giving the pressure over the days, which is what you're actually trading. And that's the most important thing, is what's applying the most pressure on the time frame you're trading. And it's going to be the 15-minute, because over in this example, the last 4 or 5 days has been downward pressure, downward pressure, downward pressure. As long as you're mindful that you've got those levels that could come into play at some point and rotate that 15-minute back, which, by the way, super popular setup, aligning yourself against the shorter term time frame, but with the longer term time frame, pushes up, starts to pull back. That's your sweet spot for buying on the long side. And you aligning with the longer time frame, using the shorter time frame as an entry point into the trade. All right, guys, take care. See you next one. Bye bye.